A pivot point is a price at which two opposing trends, i.e. a long-term trend and a short-term trend, meet in order to determine the future trend of a market. Pivot points are important because they allow us to know when we should be in the market and when we should not be in the market. So if pivot points are important, then by extension, trend lines are important. But the problem with trend lines on a price chart is that they can be very subjective. So this video has two goals. Number one, to show how to draw trend lines on a price chart in an objective manner. And number two, to show how we can determine the pivot points of a market either via a price chart or with a little bit of mathematics. How to draw trend lines in an objective manner. Please note, we will focus on the 52-week price chart, but the techniques that we will discuss can be applied to price charts of any time frame. At any given time, a price chart will exhibit some sort of uptrend and downtrend. For instance, in a strong bull market for stocks, the long-term trend will be an uptrend and the short-term trend will be a downtrend, i.e. a bearish retracement. Jesse Livermore referred to these retracements as normal reactions. So, let's see how we can generate the uptrend lines and downtrend lines for any price chart. We will start off by analyzing the closing prices. Firstly, we must note that the market high is more recent than the market low. Therefore, we say that the market has an upwards bias. Uptrends concern market lows and downtrends concern market highs. So let's analyze the market lows of our price chart. Let L0 equal the most extreme market low of our price chart. At L0, extend a horizontal line to the right and rotate this anti-clockwise until the line touches another point on the price chart. Let's refer to this point as L1. We can repeat this procedure to generate L2. And we can generate more LI points by using price charts with shorter time frames. We will now use market highs to generate downtrend lines for our price chart. Let H0 equal the most extreme market high of our price chart. From H0, extend a horizontal line to the right and then rotate this clockwise until the line touches another point on the price chart. We will refer to this point as H1. Naturally, we can repeat this process to generate H2, H3, all the way until Hj. Though as J becomes larger, we will need to use price charts with shorter time frames. Pivot points. We can generate pivot points by combining our price chart of market lows with our price chart of market highs. A pivot point is when a downtrend line intercepts an uptrend line. Every price chart can have several downtrend lines and several uptrend lines. Therefore, every price chart can have several pivot points. When a market is either range bound or in a retracement, then pivot points can serve as either number one, entry points, or number two, prices for tight stop loss orders. So for instance, let's say you have a bullish view concerning a market and the market has an upwards bias. If a pivot point is above the current price, then this pivot point can serve as an entry price. If the pivot point is below the current price, then this pivot point could be an appropriate place for your stop loss order, assuming that you are an aggressive trader. Please note, if you plan to use a pivot point as an entry price, then ideally, at the time of market entry, volume/volatility should either be very high or increasing. We can also use a little bit of mathematics to compute our pivot points. In order to do this, let the IF uptrend line be constructed with Li and Li minus 1, and let the JF downtrend line be constructed with Hi and Hi minus 1. Let Ui equal market price based solely on the IF uptrend line, which equals big MI times T plus big CI, whereby T equals time expressed as a percentage of our data tenure, which we'll set to 52 weeks. So for instance, the data from 52 weeks ago would have a T value of 0, and the most recent data would have a T value of 1. And tau of X equals the time of extreme price X expressed as a percentage of our data tenure. So we have big MI equals Li minus Li minus 1 divided by tau of Li minus tau of Li minus 1, and big CI equals Li minus big MI times tau of Li. We can also define the following. DJ, which equals market price, based solely on the JF downtrend line, which equals small mj times t plus small cj, whereby small mj equals hj minus hj minus 1, all divided by tau of hj minus tau of hj minus 1, and small cj equals hj minus hj times tau of hj. Let P of ij equal the pivot point based on the if up trend line and the if down trend line. This gives us the following. P of ij equals ui and P of ij equals dj, which implies that P of ij equals big Mi times t plus big Ci, and P of ij equals small mj times t plus small j, which implies that P of ij equals small mj times big Ci minus big Mi times small Cj, all divided by small mj minus big Mi. If you have any questions, then please either send me an email or leave a comment down below. Thank you for your time and happy trading.